Hello and welcome to a new year of Market Watch. We're starting on the 15th of January 2018. Had a few bits and pieces that I probably just need to quickly pick up for the 2 weeks that we've been trading already. You do need to look at probably the inflation data that's come out of Europe. It's been interesting, it's been slightly growing. You've also started to see some reasonable information coming out of the US, despite the fact the US dollar continues to weaken against everything, and I'll get to that in a minute. This week, what I really want to highlight is Australian data as always, and what we finished at 2017 is going to come out on Thursday, and that really highlights around what's going on at the moment with employment. 2017 will be the best year of employment growth that we've seen since 2005, and the 12 months to November, we'd already seen 375,000 jobs added. Expectations for Thursday's number are for a net figure of 20 grand. So giving that in mind, you may be looking at about 395, maybe even as good as 400,000 jobs added last year. That would be a staggering number, because what it therefore leads into, and what probably will be a 2018 story, is this push-pull between employment and wage growth. And we saw that at the end of last year, how important the wage growth index became, how much emphasis the RBA is now putting on that is all inside of that figure, all inside of what we now need to look at. So Thursday will be really interesting and really keen. I also want to highlight what's going on in China. GDP is out on Thursday, along with industrial production, retail sales, and fixed asset investment. GDP and IP are the ones to look at. Already, we've pretty much been told what it's probably going to come in at. We saw Premier Li Keqiang last week saying that he expects Chinese growth to come in at 6.9%, which will probably mean it will come in at 6.9%. He also then said that he expects 2018 to be almost a reflection of 2018. So therefore, those of you that are slightly bearish, be aware that China is expecting to see GDP around that figure and most likely to expect it. And that's why the industrial production comes into it. It's bounced well off that 25-year low that we saw once last year and the year before. It's moving towards a growth figure of around 7.1 to 7.4%. That is what they would classify as stable. And that is a very good thing for growth and for things like materials here in Australia, because their demand for our products have not really slowed down in 2017, and growth remains the core piece of 2018. Interesting chart I've put on screen right now. This is actually from Morgan Stanley, and they have got a beautiful chart here. Those four screens are clearly showing the sort of the cycle around this, and as far as they're showing you, we're sitting in the Goldilocks scenario. It is likely that we're going to have, fairly reasonable accommodative monetary policy throughout 2018, despite it starting to tighten. Inflation is very slowly materializing, if at all. You've got risk on the up, you've got growth on the up. It's all that little Goldilocks scenario, and China might tell you that on Thursday. It's a really interesting scenario that's going on in that space. In 2018, some people believe it will be the peak of this growth cycle that's been going on for 3 years, and all of that will be leading to positive equity markets, which we already have, leading to positive sentiment, maybe leading to wage growth, maybe leading to increased consumption, maybe leading to output increases in GDP as well. All of that is there, and that's what this year will be about, and something that I'll be talking to you about over that period. But with that, have a good week.